Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, China's new rare earth rule targets Nvidia and Intel weaponizing supply chains and threatening the Fed's disinflation narrative. So we'll discuss why this symmetrical trade weaponization could trigger a global cost push shock and what it means for the Fed's anticipated rate cuts. Second, JPMorgan's $1.5 trillion reshoring plan aims to build a non-Chinese industrial base, signaling a new era of financial decoupling. We'll explore how this private capital push into national security sectors creates an inflationary headwind and challenges the Fed's long-term interest rate path. Third, a government shutdown hammers West Virginia, where federal jobs outnumber coal miners, creating a localized recession in Trump country. We'll examine how this massive income shock is creating a real-time stress test for household finances with potential ripple effects for wider credit markets. A new rule out of China could force companies like Nvidia, TSMC, and Intel to get permission from Beijing to sell their products inside the United States. This is the latest shot in a rapidly escalating trade conflict. The rule targets any product manufactured anywhere in the world if it contains Chinese rare earths worth a mere 0.1% of its total value. Now, that 0.1% threshold sounds small, but it's actually incredibly broad. The leverage for Beijing comes from its market dominance. China controls about 70% of global rare earth mining and a staggering 90% of the processing. This means countless electronic and automotive products could be affected. Economists are concerned this could trigger a significant cost push shock to global prices. A while back, we analysed how tariff shocks almost fully pass through to import and consumer prices. Today's wrinkle is that this isn't a tariff at all. It's a licensing choke point buried deep in supply chains. So the real threat here is to the disinflation narrative for central banks like the Fed and the ECB, potentially delaying much anticipated rate cuts or even forcing them to reconsider their strategies. That's precisely the kind of shock some Fed officials had been inclined to see as transient, and this could challenge that view. You see, this isn't just about a few companies. It could impact global monetary policy. This move came just after Beijing announced a new framework for restricting rare earths exports, placed more US companies on a blacklist, and charged US linked ships new fees for docking at Chinese ports. In response, Donald Trump threatened 100% more tariffs on Chinese goods. We previously noted that a 100% tariff would almost certainly trigger a rapid inflationary shock. That scenario is now back on the table alongside sweeping software and export controls. According to Macquarie's chief China economist, the root cause is a severe lack of mutual trust. He says that following a previous agreement involving rare earth for tech, both sides now feel betrayed, perceiving the other as acting in bad faith. We've been flagging this shift for a while. The market's old assumption of frictionless long-term global growth is giving way to a higher, possibly persistent geopolitical risk premium. And this trust deficit has a real measurable effect on the market. Actually, this collapse of trust now acts as a volatility multiplier. It means that markets are far more likely to overreact to negative headlines and price in worst-case scenarios. Remember, we've seen how a single political threat can vaporize hundreds of billions built on AI optimism and global trade. This is that same repricing dynamic in action. This is why we see larger than expected stock price drops for globally exposed companies like Nvidia and Intel, even if behind the scenes diplomatic solutions are still possible. For Chinese-speaking audiences, this implies that companies in China with high revenue exposure to the US market could also face similar volatility and increased risk, with added pressure on the RMB if decoupling hardens. Continuing our last discussion on how export rules are being mirrored and extended across borders, the situation this time is somewhat different. This isn't just reactionary anger. It's a calculated strategic escalation. Analysts point out that China's new rule is deliberately modeled after the US Commerce Department's own foreign direct product rule, which imposes a license requirement on any product made with US origin technology, no matter where it is produced, and it's crucial to understand the context here. As we've discussed before, the US Foreign Direct Product Rule, or FDP, is a powerful tool designed to extend American export controls beyond its borders. The US has used it to restrict China's access to advanced semiconductors and supercomputing tech. So China's move isn't just a simple tariff, it's what experts call symmetrical trade weaponization. This is a new phase in the conflict. The fallout is a costly and painful re-architecting of global supply chains for everyone, which could create long-term structural inflation. While officials may search for a short-term fix, the fundamental relationship may be broken. As a senior economist for Greater China at Natixis states, a lasting solution is unlikely. The trust between them is already gone. That's why we previously warned that confidence in a steady path of rate cuts left markets vulnerable to a sharp repricing, expect a stickier risk premium, and a bumpier policy path from here. What really brought this to a head was the realization that we are witnessing a live test of China's ability to conduct surgical economic warfare. When we place this alongside Russia's use of energy exports, which was a blunt instrument, the contrast becomes clear. China's approach with rare earths appears more moderate and controlled, aiming for precision. If Beijing views this as a success, it could create a playbook for weaponizing other critical dependencies, like graphite for batteries or pharmaceutical precursors. This would fundamentally alter geopolitical risk for industries worldwide and accelerate the push by the US and Europe towards so-called friendshoring of their supply chains. The key focal point to watch now will be the issuance rate of these new export licenses and any fluctuations in global rare earth prices. On the macro side, keep an eye on upcoming CPI and PCE prints, labour market data like JOLTS and jobless claims, and any shifts in corporate capital expenditure and supply chain guidance. If data get disrupted again, policymakers could be flying blind just as these trade shocks hit. Speaking of re-architecting global supply chains, it's not just governments making moves. America's largest bank is now stepping into the arena in a massive way. JPMorgan Chase just unveiled a plan to facilitate a staggering $1.5 trillion in funding for a direct shot across the bow of those very supply chains. This massive capital commitment is a powerful signal that the trend of reshoring or bringing manufacturing back to home soil is accelerating. The catch, of course, is that this process is inherently inflationary. Moving production from lower-cost overseas locations to higher-cost domestic ones inevitably raises expenses. This complicates the Federal Reserve's long-term fight against inflation and could mean interest rates stay elevated for longer than we might expect. CEO Jamie Dimon stated it has become, quote, painfully clear that the United States has allowed itself to become too reliant on unreliable sources for products essential to national security. Believe it or not, this statement represents a new phase of what some call financial decoupling. It's moving beyond simple investment restrictions to actively using private capital to build a competitive, non-Chinese industrial base in cutting-edge technology. This is a significant shift. To drive this, the bank is launching a decade-long plan to directly invest up to $10 billion into companies it deems crucial to American interests. The bank says this broader effort is 50% larger than a previous plan, signaling a massive acceleration. The targets are not your typical blue chip stocks. We're talking about 27 specific industries, from frontier technologies like AI and quantum computing to nanomaterials, autonomous robots, and even spacecraft and space launches. The goal is to reshape the foundation of American industry from defense and aerospace to advanced manufacturing. Here's where it gets interesting. This list of industries isn't something JPMorgan just came up with. It closely mirrors the US Department of Defense's own list of 14 critical technology areas essential for national security. This includes fields like microelectronics, biotechnology, and quantum science. The alignment is so precise it suggests a convergence of private capital and government strategic priorities. This is a private bank proactively shaping industrial policy, essentially trying to create a new class of national champion companies. This move formally organises the financial giants' activities around national interests, coming at a time of heightened geopolitical tensions. Dimon was blunt, calling for the removal of obstacles like excessive regulations and partisan gridlock to secure America's economic future. The situation presents a fascinating duality. On one side, you have America's market-based answer, while on the other, China is tackling the same issue through its state-run Big Fund, a massive national investment fund aimed at bolstering its own semiconductor industry. The latest phase of that fund raised nearly $48 billion. JP Morgan's initiative could trigger further competition and fragment global capital markets. For Chinese listeners, this means the competition in high-tech industries like semiconductors is intensifying, which could affect related companies and employment opportunities in China. However, if you zoom out, you'll see another layer to this strategy. In a call with reporters, Diamond was clear that despite the national security angle, the bank does not expect, quote, lower than commercial returns on this initiative. After all, this is an incredibly bold claim. These deep tech sectors like advanced materials and quantum computing are famous for having very long and uncertain payback periods. Venture capital data shows that investments in these areas often have lower internal rates of return compared to something like software. They historically require significant state support or subsidies to get off the ground. Whether a private bank can achieve full commercial returns on its own is the big question. This isn't just a funding announcement, it's a calculated strategy from America's largest bank. JPMorgan is positioning itself at the center of a national effort to onshore critical industries, from semiconductors to energy tech, signaling a major shift in how corporate power and national security are becoming intertwined. So, what should we watch for next? First, keep an eye on the stock market. This massive financing focus will likely create a security premium for companies in these targeted sectors. We're already seeing aerospace and defense ETFs outperforming the broader market. This means investors may need to adjust how they value these anointed companies, while firms in non-favored industries could find it harder to attract capital. Second, watch inflation indicators like the CPI. As mentioned, reshoring is costly. A 2025 industry survey showed that for many companies, it could double their supply chain costs. If this large-scale shift continues, it could create a persistent inflationary impulse. The ultimate test will be whether JPMorgan can actually deliver on its promise of commercial returns. If it can't, it could signal a misallocation of private capital that ultimately disappoints shareholders and may require future government subsidies to sustain. We were just talking about a massive private sector push to reshape the American economy. Now, let's shift our focus to a place where the public sector's failure to simply keep the lights on is creating a very different kind of economic reality. Get this. In West Virginia, a state synonymous with coal, there is a stunning economic reality most people miss. According to the West Virginia Center on Budget and Policy, the state has more federal government employees than coal miners. And right now, that fact is turning into a crisis. This heavy dependence on federal employment creates what economists call regional economic fragility. Essentially, when the government, the main employer, suddenly stops paying its workers, it can trigger a localized recession. These are economic downturns so concentrated in one area that they might not even show up in the big national statistics right away, hiding a serious vulnerability in the economy. A while back, we talked about how shutdowns aren't just theatre. Each week can shave roughly 0.2 percentage points, about $6.5 billion from real GDP if it drags on. That's the macro strain behind the very local pain we're seeing now. The government shutdown is hitting the heart of what the news calls Trump country, and the numbers are staggering. In the city of Martinsburg, with a population of just under 20,000, federal agencies employ over 3,300 people. Another 1,000 commute to the nation's capital every day. These aren't just statistics. They are the lifeblood of the local economy. Now, that lifeblood is being cut off. Nationwide, the political deadlock has put more than 700,000 people on unpaid leave, with another 200,000 essential personnel working without pay. The White House has begun laying off thousands of federal employees. And as we noted a while back, federal contractors often aren't guaranteed back pay, so the true income hit on Main Street is even bigger than the furlough count suggests. So the thing is, a government shutdown acts like a sudden massive income shock for this specific group of people, and we're already seeing the consequences in the data. For federal workers, the 30-day delinquency rate on credit cards, that's people who are at least a month behind on their payments, has already started to spike. This is a real-time test of how financially resilient households are, and it could be a warning sign of wider credit problems if the job market weakens more broadly. We previously flagged another stress gauge to watch: the cost to insure US debt via credit default swaps. If those spreads widen again, that's markets actively pricing in political dysfunction rather than brushing it off as background noise. On the ground in Martinsburg, the impact is immediate and personal. A United States Department of Agriculture service center for 7 counties is shuttered, and the impact goes beyond just the employees not getting paid. The closure of a USDA office, for instance, has wider consequences. These centres are where farmers get critical support like loans for seed and equipment or disaster assistance after a flood or drought. Without these services, farmers can face delays in planting their crops. This administrative bottleneck can disrupt the agricultural supply chain, potentially causing localized food price volatility and even affecting export flows to major trading partners like China and the EU. And tying this to our earlier conversations about de-dollarization risk, when shutdowns look chronic, major foreign holders of US treasuries think China and Japan take note, and any accelerated diversification away from the dollar would mean persistently higher borrowing costs for the US. A massive IRS facility is next, with 34,000 workers furloughed. For veterans in the area, the shutdown means critical programs for jobs and housing are frozen. One Air Force veteran, Marcellus Brothers, put it bluntly, "We're in limbo, it's scary." Small businesses are bracing for impact as their customer base. The federal workers stop spending. Local leaders warn that the ripple effects could be devastating in a state that has the third highest number of federal employees per capita in the country. We mentioned before that the spectacle itself can dent consumer confidence, especially risky heading into the holiday season, and uncertainty like this can prompt businesses to slow hiring and postpone investment if a resolution isn't swift. And these ripple effects are starting to worry people on a much larger scale. The increasing frequency of these government shutdowns is creating a new kind of economic uncertainty, with some analysts beginning to view them as a dysfunctional form of fiscal policy. The real danger is how this erodes confidence in the US government's ability to manage its own affairs. Think back to the 2011 debt ceiling.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.